You guys see the screen? This white screen, whatever it's showing. This is the first time I'm using it, so just making sure. Good evening, Alex. Just let me know in the chat. So just type one if you can see it, so that we can just continue ahead. Okay, stop drawing in the chat. Right, beautiful. All right, so let's get started. I'm pretty sure most of you in here are familiar with options, right? So options, we have two things when it comes to options. Number one is calls and the other one is puts, right? They're separated into two different categories. And one is calls. The second one will be puts. So if you've been trading single-legged options before, all you've been doing so far is buying call option of a particular strike price. And if stock price goes up, you're going to make money. And or buying put options, if the stock price goes down, you're going to be making money sort of scenario. But these call options and put options are categorized into two different categories, by the way. For example, you can buy a call option and you can sell a call option. How many of you in here have done covered calls? Anyone tried covered calls before or cash secured puts? Anyone done any of it? If you guys are familiar with it, let me know, or else we can go over it in detail. That's fine. Type one if you have done it, type two if you haven't. So it will be familiar with us, familiar for us down the road. Okay, so we'll discuss both of them together. All right, so are normal calls the same as? No, Alex, it's completely different. Completely different. All right, so not a lot of people done that. Okay. All right, so I'm pretty sure most of you in here have actually bought a call and actually bought a put, which means if it goes up, you'll make money for calls, and if it goes down, you'll make money for puts. So calls, the concepts are pretty simple, right? So you'll make money if the stock price goes up, and you can pick your expiration. It is a bullish strategy, right? It's a bullish strategy because you'll only make money if the stock price is going higher from your entry price. That is call option. And same with the put options, right? It's pretty simple, basic concept. So you'll make money if the stock price goes down, which makes it a bearish strategy, right? If you bought a call option when SPY is trading somewhere around $500 and you bought a 500 strike price, and if the stock price goes to like 502 or 503, you're going to be making money on calls. Similar to that, if you bought a put option when SPY was trading at $500, if SPY goes down to like 498 or 497, you're going to be making money on a put options. So calls and puts, the basics are pretty much self-explanatory. I'm pretty sure like all of you in here, like four of you in here, pretty sure you have done both calls and puts. Now let's talk about the sell side a little bit. Sell side, if you sell a call, I'm pretty sure if you have Robinhood or any other brokerages, you will be seeing two things on your brokerage. One will be buy and the other side will be sell. Have you ever toggled around the sell side icon, by the way? Have you ever wondered what that actually means? Why do you have a buy and sell icon, and then right next to it, you'll see a call and a put right on top as soon as you open the option chains? Even before you scroll through the strike price, right above, you'll see something like buy, sell, call, put, followed by a lot of strike prices under. And then like up top, you'll see all those different expirations mentioned above in Robinhood. So now, have you ever wondered what those sell side means? That's what we're going to talk about. Number one, we'll start with covered calls. We'll start with what covered calls means, and then we'll go to what is cash secured puts. All right. So let's say you have 100 shares on a particular stock. Let's assume in this scenario, 100 shares of SPY. Let's assume you have 100 shares of SPY at cost average of $540, let's assume. So let's say you have 100 shares of SPY at $540. And SPY is going higher and higher and higher. And currently, let's assume the SPY is trading at around 560, just an assumption. So right now, you made like $20 in profit, which is almost $2,000 worth of gains. So now you're looking at a call option and you want some protection to the downside, and you're looking at the charts and you don't want to get rid of SPY because it's a long-term hold, let's assume. So let's say you go ahead and sell a 545 call option, not buying, but selling $545 calls, expiring 21 days from now. Right? So now what's going to happen to this is, like, when you buy a call, what typically happens? When you buy a call, let's say this 545 calls is actually going for like $600, which is 6.00 in option terms, which is nothing but $600 when it comes to the actual dollar count. All right. So let's say this is actually going for $600. If you're buying this call, the $600 will be taken off of your buying power. If you have $2,000 in your buying power, they will take out the $600 from there, and you can just open the call option. If the SPY keeps continuing to go higher, you're going to be making money. If it continues to go down, you're going to be losing money, right? Now, when you're selling a call option, it's completely opposite. What's going to happen? First things first, you need to have 100 shares as collateral in order to even open these positions, by the way. First things first, 100 shares in collateral is required. You need to have 100 shares before even thinking about selling covered calls. So let's say you have 100 shares of SPY according to the scenario, and you sell this 545 calls. So what's going to happen here is, instead of them taking the $600 from your buying power, you're going to get credited $600 as soon as you make the purchase. So technically speaking, right now your buying power will go up from $2,000 to $2,600. So this is a credit-based strategy. So in order to open this, you need to have 100 shares. So now how do you make money on this? Because you know how to make money on calls, because if it goes up, you're going to make money. But covered calls are completely opposite, by the way. Covered calls are a bearish strategy, completely opposite to that of buying a call. So as we'll just write this down right here, just make a note of it. Might come in handy down the road. Selling a call is a bearish strategy, which means you're only going to be making money if the stock price is actually going lower. All right. So now, let's say you bought this covered call, or you sold this covered call, and you got a $600 in credit. This $600 credits, which you got when you open this position, is the maximum profit which you can make on this trade. Unlike the regular call options which you buy, which means, like, if the SPY keeps going higher and higher and higher, the maximum money which you'll be making is unlimited, right? If the SPY just gaps up to like 590 or whatever it is because of some Elon Musk found some cure for cancer or whatever the hell happened, right? Or Apple just found a cure for cancer, Apple just goes up all the way to like 70% in a single day. It's hypothetical scenarios. If SPY goes up to like 590, the call options which you're buying have no upside cap, by the way. But when you're selling an option, the upside cap on this is $600. That's the maximum amount of money which you can make. How you will make this is, let's say when the market opens and you bought this contract when SPY was trading at around $560, next day some news event happens and then the SPY just drops. If SPY dropped all the way to like $555, it's $5 under your entry price. So now for each dollar it goes down, the delta on this is going to tell you how much money you're going to be making. And note that you're only going to be making money if the stock price is going down from your entry price. First things first. So because it is a bearish strategy. First one. The next one, since it's a credit-based strategy, whatever the disadvantages which you have when you are buying a call option, it's going to turn into an advantage. How many of you have lost money because of theta decay? I mean, your stocks will just be trading flat, but your option contract is still going to be losing money, right? But unlike that, that theta decay, it's going to make you money here, by the way. Let's say you open this at 560 and SPY was just trading flat for the entirety of the day and closes the day at 559 or something. All right, it still went down, but it didn't move a lot. It didn't do a lot. It was just trading flat throughout the entirety of the day. And trading flat is good. Trading flat is a good thing as long as it stays under 545. 545? Doesn't matter. Let's assume the SPY is trading at around 545. All right. So as long as it stays under your strike price, and as long as the price stays under the strike price and keeps on consolidating, consolidation is an advantage. Theta decay is going to make you money. And how many of you traded earnings here? And have you ever like got into this situation where like you just buy a call and then like the stock price goes up, the next day you see the options price, which is, even if the stock price going up, you still lose money because of the IV crush. IV crush is a bad thing for buying a call, but IV crush is going to make you money if you're an option seller. IV crush is an advantage. So now let's say the next day CPI is dropping on SPY and SPY just collapsed altogether to the downside, or SPY just trading flat. If SPY trading flat, you're going to be making money when it comes to the options, when it comes to selling options. So now two things to take away from this. The first things is selling calls is a bearish strategy. First things first. The next thing to take away from this is the maximum amount of money which you will be making is capped to the credits which you initially received. So now, let's say the SPY keeps going higher. SPY keeps going higher and higher and higher and higher, and there is no stopping SPY here. And let's say it went all the way to like 560 according to this example. All right, but you sold 545 calls for $600 credit. Right now, SPY is trading at 560. Your cost average on the shares is 540. If you are buying a call option, what will typically happen? If you bought a call option, if SPY goes up $20 from your entry, you're going to be making a lot of money, right? But in this, let's say by expiration, SPY closed at 560. What the brokerage is going to do is they are going to exercise this call option which you sold, and they're going to sell your 100 shares at $545 each. Even if the SPY is trading at 560, by the way. Even if SPY is trading at 560 at the moment, since you sold the 545 calls, by your expiration on this call, SPY should be trading under 545. If not, they are going to exercise this call and then sell your 100 shares of SPY, which you bought at $540 at 545 each, even if the current stock price is at 560. That is a downside advantage. So this is why you don't do this when the stock is actually in an uptrend, by the way, because you are capping your upside potential. If the stock price keeps continuing to push higher and higher and higher, and you sold a call too close to the expiration, you're going to be losing. You're not losing a lot of money technically, but you're capping your upside potential to a greater extent, which is not a recommended thing to do. But so far, this strategy is what we call as covered calls, by the way. People technically do this in order to protect their positions from downside risk, or let's say like the stocks which they are in are not, are just trading flat and not making any money. For example, do you guys remember NTAP, which we traded for 2 weeks? It didn't do anything. On stocks like that, let's say, especially if you have 100 shares on the stock, you can sell like these covered calls. And let's say it goes up, they're going to assign your calls, and you're just going to get rid of the 100 shares at the strike price of the calls that you sold. But if, let's say, the stock is just trading flat, your shares are not making any money, but these options that you sold are going to be making money, because trading flat is a good thing when you're an option seller. Trading flat is a terrible thing if you're an options buyer. So completely different story. So whatever disadvantage you have when you're buying a call option, it's going to be an advantage when you're selling. All right. So far, are we clear on what covered calls means? I'm going to give you guys access to unmute yourself. So if you have any questions, go ahead and let me know. So let's see. So you need 100 shares for covered calls, whereas normal calls, you can just buy it and sell it on the stock. Yes, correct. You need to have 100 shares as a collateral in order to buy covered calls, in order to sell covered calls. Main reason is when you sell an option, unlike when you're buying it, the maximum risk will be, let's say you bought this 545 calls, and let's say it goes completely against you. the maximum risk is $600, right? Like if you bought this call option, the maximum you'll be losing is $600. But when you sell a call option, and if you don't have 100 shares in collateral, well, the maximum you'll be losing is unlimited because there's no telling that how much higher the stock price is going to go, right? So this is where this collateral comes in, by the way. This collateral is going to act as a safety net. So it just in case if stock price just continues to keep pushing higher and higher and higher, you're giving the brokerage the right and the obligation to get rid of your 100 shares at the strike price of the call option, just in case for a safety net. It becomes a protected trade. So in the worst case scenario, you're going to get rid of your shares at $545 each. In the best case scenario, if the stock price continues to keep going lower and lower and lower, you get to keep the $600 in premiums. All right. So this is what covered calls means. So all these stuff is like prerequisites knowledge. Exactly. Yep. So this is basics of covered calls. You need to know the basics of covered calls. You need to know the basics of cash secured puts as well, which is what we're going to talk about right now. So just to recap, buying a call is a bullish strategy. Selling a call is a bearish strategy. All right. So we went over the basics of how selling actually works. If you're selling a call, you're going to get credited with premiums, whereas when you're buying a call, you'll be debited premium from your buying power. If you're having a $2,000 account and if you're going to take this trade, and if you're going to buy a 545 call, they're going to take $600 from your buying power, which means right now your buying power will be $1,400 after this trade is taken. But if you're selling this call with a $2,000 account, as soon as you open the trade, you'll be credited $600 in buying power. Another advantage of buying a call here is your profits are not capped. It's unlimited to the upside. As long as the stock keeps working in your favor, you're going to keep making money. But when it comes to the sell side, your profits are capped, which means the maximum profits which you'll be making is the credits which you receive when you open the trade in this scenario, which is $600. All right. So this is the basics of covered calls, by the way. And this is going to come in handy down the road when we start discussing about spreads. All right. So now let's talk about cash secured puts. Anyone ever done cash secured puts before to buy shares at cheaper prices? Anyone here? No? Okay. All right, let's talk about it. So when it comes to the put side, similar to what we discussed in the call side, there are two different types, right? So you can buy a put and you can sell a put. So when it comes to selling a put, just like how buying a put is a bearish strategy, it's a complete opposite. Selling a put is a bullish strategy, by the way. It's a complete, you'll see a theme here. It's whenever you are selling an option, it's a complete flip on what's going to happen on the buy side, by the way. So if someone is making money, someone is losing money, right? If you sold a put to someone, and then if they're losing money, you're making money. If you bought a put, and if you're making money, someone else who sold it to you is actually losing money. So whatever the concept which you learned so far with the buy side, it's going to be complete opposite when it comes to the sell side. All right. For example, like buying a call is a bullish strategy, whereas selling a call is bearish. Buying a put is a bearish strategy, whereas selling a put is bullish. So the strategy where you sell a put with like collateral is what we call as cash secured puts. By the way, I'll just write this down if you want to take it down in your notes. So in bearish here, we call it as covered calls. Just one of the strategies, by the way, there's a lot of it, but for now, just understand covered calls. And when it comes to puts, it's cash secured puts. This is what selling puts means. Selling puts refers to selling puts with proper collateral. So when we spoke about covered calls, to remember how we discussed, like you need to have 100 shares in collateral, 100 shares of the underlying stock in order to actually sell a covered call. Similar to that, same concept, but you need to have the money in the buying power to actually buy 100 shares if you want to sell a put. Let me repeat it again. In covered calls, you have to have 100 shares in your portfolio before even doing that, right? But when you're coming to selling a put, you need to have the money to buy 100 shares of that stock price in your buying power. All right. So this is for cash secured puts, by the way. And for covered calls, you have to have 100 shares. But for cash secured puts, you need to have the money to buy that 100 shares if things goes against you. Let me give you guys an example. Let's say SPY is, what's the current price of SPY, by the way? SPY is currently trading at, let's see, $544. That's what the current price of SPY is. All right. The SPY's current price is $544. And you look at the charts and a longer time frame of SPY is still looking good and everything is looking absolutely phenomenal. But you don't want to buy it right here because the SPY just rallied quite a few dollars to the upside and you want to wait for it to pull back a little. Instead of waiting and sitting on your hands, what people typically do is they're going to go open their option chains and they're going to go 21 days to expiration and they're going to pick $530 puts and they're going to sell it. All right. So now when you sell this $530 puts, let's say like you're comfortable buying SPY at 530, but you're not comfortable buying SPY at 544. So instead of sitting on your hands and waiting, what the people typically do here is they're just going to go 21 days out. They're going to sell the 530 puts and they're going to collect premiums off of it. So let's say 530 puts is going for, let's assume $4.50, which is $450 in dollar terms. Right? So now, if you want to buy this put, $450 will be taken away from your buying power, right? And if the SPY drops all the way to 530, you're going to be making a lot of money. But now you're actually bullish on SPY. You're just waiting for a slight pullback so that you can buy some shares at cheaper price. So now on this scenario, what you're going to do is you're going to go ahead and sell this 530 puts. What's going to happen when you sell this 530 puts? You're going to immediately get credited $450 in your buying power. So now, how will you make money on this? Let's say SPY just by your expiration, 21 days from now, SPY closed above 530, even a single cent above 530. You get to keep this entire profit, entire credits which you received in profits, which is 450. You get to make this $450 if SPY closed above $530 by your expiration. That's all you need. That's all you need, by the way. As long as it closes above 530, you get to keep the 100% of the credits which you received. But here's where the things get interesting. Let's say some nonsense happened and then the SPY goes all the way to like 528 or something, which is $2 under your strike price. And let's say by your expiration, SPY closed at $528. If the SPY closes at $528, what the market is going to do is they're going to assign your puts and they're going to make you buy 100 shares of SPY at cost average of $530 each, even if the SPY is currently trading at 528, by the way, because that's the strike price of the puts which you actually bought. So this is one of the main reasons why, as we mentioned before, you need to have buying power of $53,000, which will be held as collateral in order to even open this position, by the way. So 530 puts is what you got, right? 530 multiplied by 100 is what you need to be having in your buying power, which is 53,000. So that is there in place because just in case you get assigned, like the scenario which I just outlined, they're going to assign your shares and they're going to give you 500 shares at $530 each. So when you get assigned, you're technically buying the shares at a lower price. But here's the worst case scenario. Let's say SPY drops all the way to $500 by your expiration and you still held on to it. SPY is trading at $500 right now. And if you didn't manage this properly, even if the SPY is trading at $500, you'll still be having $530 cost average as soon as the options got exercised or assigned, by the way. Even if the SPY's market price is actually $500. You can buy it back cheaper in the market price, but if you don't manage the same, you're going to be stuck holding the bag at $530 each, even if the market price is 500. So how do you make money on this? So let's say if this, and you got this, there's a disadvantage, which is also an advantage, but depends on how you look at it. So let's say like after you bought this put, after you sold this put, SPY just keeps going all the way to 550. Current price is 544. And you bought this today, 530 puts. You sold it today and you got credited $450 in your buying power. And then Monday next week, SPY just closed at around 550. And the week after, SPY closed at around 560. And by your expiration, let's say the SPY just closed at 555 or something. 555 is still higher than that of 530 puts which you sold. So now, just because it's higher, right now you get to keep 100% of the credits which you received, and you just profited $450 in this trade. And let's say in this other scenario, 550 was the next week, and the other week SPY goes all the way down to 540. By your expiration, SPY closed at $531. $531. The SPY still dropped, by the way. SPY still dropped like almost how many dollars from your entry? Almost $13 from your entry price of 554. But since it's still above this $530 strike price, you still get to keep the entirety of this premium, which is $450. As long as it closes above $530, you get to keep the entirety of your premium. This is what we call as cash secured puts, by the way. You can see how it's a bullish strategy. You need the price to stay above the strike price in order to keep the entirety of your premiums. Whereas when it comes to the covered calls, you need the price to stay below the strike price of your calls in order to keep the entirety of your premium. So thus, selling calls is a bearish strategy, whereas selling puts is a bullish strategy. All right. So now, hope you're clear so far. I'm going to stop this right here. So let me know if you have any questions so far before we push through. Let me see, we got one. So selling side of options are probably not good for small account. Like you can sell options with $5,000 account, Alex. Unlike stocks like Snap or Grind, where the stock prices, yep, because you need at least 100 shares for collateral, for covered calls. You don't need 100 shares for cash secured puts. You just need money to buy potentially that 100 shares. Just if, let's say, like you are planning on selling cash secured puts on Snap. All right. And Snap is trading at $17 right now. So you need to have at least $1,700. And let's say like you're planning on selling puts on Snap for $15 strike price, 21 days out, which means if Snap pulls back to $15, you're willing to buy it. You're willing to buy it for down the road. And let's say you sold the $15 puts, $15 puts and 21 days expiration, and you got a credit for somewhere around $60. And if Snap closes by your expiration at $17, 21 days from now, let's say Snap closes at around $16 or $16.50, it is still above the $15 zone, which $15 puts which you sold. So you get to keep that $60 in profits, which is the maximum amount of profits that you can make. But let's say Snap pulls back to 15 and by expiration, it closes at around like 15.30 or like around 14.90 or whatever it is. They're going to assign your puts and they're going to force you to buy 100 shares at $15 each. This is for puts. Now, let's say you already have 100 shares on Snap. Let's say you already have 100 shares on Snap. Let's say at cost basis of 15.30. That's where we average entered, right? 15.30. And now stock price is going up and you see some cracks in the trend and the price starts losing the 5-day moving average and all this other nonsense happens. And let's say you sold a $17 call when this happens. And as soon as you sold a $17 call 21 days out, let's say you get a credit for $70. And let's say Snap just like, it was just a fake out and from next day, it just kept going higher and higher. And by your expiration, let's say Snap closes at $18, which is $1 above the strike price of the calls which you sold. During that scenario, what's going to happen is even if the Snap is currently trading at $18, they're still going to sell your 100 shares at $17 each because that's the strike price of the calls which you sold. So selling calls on an uptrend caps your upside profit. So you can sell calls and take that. What people typically do is they're going to sell calls, they're going to receive premiums for it, right? They're going to take the premiums and then buy puts. So what's technically going to happen is now their shares are protected to the downside. If the stock price keeps falling lower and lower, their puts are going to keep making them money. If the stock price keeps going higher and higher, well, their shares are still going to be making them money, but their upside profits are capped. This is how they protect the downside. That's what we did with HPQ, by the way. We did the same with HPQ a while back. This is what we call as synthetic long position. But it's outside of the scope for today's session. For now, I hope the covered calls and cash secured puts are clear, by the way, because this is most important when we start with spreads. These two are going to play a major role.
Mario, I have a question.
Go ahead, Franklin.
These credit spreads, we could close them whenever?
Yes, you can close whenever
Oh,
you
we
want.
gotta wait till the expiration.
No. You can, yes, just like any other options. You can close them whenever you want, similar to the covered calls. You don't have to wait till expiration. You can close any time you want, just like how you deal with regular calls and regular puts. Right? So anything else when in regards to covered calls and cash secured puts? We clear? All right, so let's get going. So now there is this, so exercising happens when it expires. Exercising and assignments happen if your options expire in the money. Let's just leave it at that. Let's say like your options expire in the money, not out of the money. I hope you know what in the money and out of the money means. So in the money means, let's say like your stock price is trading at 540. If it's a call, anything under 540 is in the money options, like 535, 530, all these are in the money options. Anything above that 540 is out of the money. Similar to that for the puts, anything above is in the money, anything below is out of the money. For example, same 540 is the current price. Anything above 540 on the puts is referred to as in the money. Anything under 540 is referred to as out of the money. If your positions expire in the money, they're going to exercise it or assign it. Doesn't matter if you bought it, doesn't matter if you sold it. That's how typically things goes. All right, so now let's start with spreads. Similar to the regular options, we went over what basics of covered calls means, what basics of cash secured puts means. When it comes to spreads, what we're going to do is we are going to combine both of them together when opening the same trade. So if you're buying a call, we're going to combine a buy side, and we're also going to combine a sell side in a same trade. For example, if you buy a call, you just buy like one call, right? It doesn't matter how many contracts you buy, but it's just one strike price. Let's say today you bought like $540 call options. And doesn't matter if you bought like 10 of them, 20 of them, 1,000 of them, it's just one 540 call option. That's the strike price. And if you sold 540 calls as well to the sell side for covered calls, doesn't matter how many contracts you did for, but it's still 540, just one. But when it comes to spreads, you're going to be combining two of them together. For example, what you're going to do here is you're going to be buying a $540 calls, and you're going to be selling a 545 calls, both at the same time. Both at the same time on the same trade, similar to the puts. You're going to be, let's say you assume that you're going to be buying 540 puts, and simultaneously you're going to be selling 545 puts alongside with it, both at the same exact time. So now hope it makes sense why we went over covered calls and cash secured puts, by the way, because you need to understand how selling works before understanding spreads, before understanding the basics of spreads. So covered calls and cash secured puts, we went over the basics. Now spreads, just like how we categorized options, spreads can be categorized into multiple stuffs as well. But for this class, all we're going to focus on is something called as vertical spreads. That's what we're going to be focusing on into this class. I'll tell you what it means. I'll tell you what it means, what vertical spreads typically refers to. So if you go to your option chains, it's pretty simple explanation will be this. If you go to your option chains, remember how I said like you'll be opening two different contracts at the same time? Now, if you go to a SPY option chain, which expires on Monday, and you're going to see the expiration dates about buy, sell, call, puts, and then different strike prices trading under, right? So you're going to be seeing buy, you're going to be seeing sell, and you're going to be seeing calls, you're going to be seeing puts, and all the expirations under. But all these strike prices are falling under the same expiration. Whereas why it's called vertical spreads is because you're going to be buying a strike price and selling a strike price of same exact expiration in a vertical manner. It's like buying and selling on the same strike, same expiration date, but different strike prices. Since it has the vertical nature to it, we call it vertical spreads. There's another thing called horizontal spreads where like you will be buying and selling different strike prices in different expiration, where like it goes something like this instead of going something like this. This is horizontal spreads, whereas if since we are buying and selling on the same expiration, we call that vertical spreads, by the way. All right. So similar to the calls and puts of options, vertical spreads can be categorized into two categories, by the way, two different things. So the first thing is what we call as credit spreads. The second one is what we call as debit spreads, by the way. So let me just write it down. Credit spreads. The next one will be debit spreads. All right. So now two categories of spreads, debit, credit, and this is under the subcategory of, these are the subcategories of vertical spreads. All right. So now just pay attention to whatever I'm going to say, but I will explain the same in detail down the road. All right. So it's just because, just like how we did with calls and puts, buying a call is a bullish strategy, selling a call is a bearish strategy, right? So those credit spreads are subcategorized into two. Similar to that, debit spreads are subcategorized into two as well. All right. So let's just talk about it briefly, and I'll explain what it means down the road. Just take it down in the notes, just for now. Call credit spreads. Copy this. And put credit spreads. And similar to that, you got call debit spreads. And you got put debit spreads. All right. So let me just zoom in. Hope you guys wrote this down. For now, just try to follow along. I will explain what all of these means down the line. Spreads, we're going to talk about vertical spreads in general. Vertical spreads are split into two, credit spreads and debit spreads. Credit spreads is subcategorized into, similar to how options are separated by calls and puts, right? And when it comes to credit spreads, it's subcategorized into call credit spreads and put credit spreads. When it comes to debit spreads, it's subcategorized into call debit spreads and put debit spreads, by the way. All right. So now go back to the example which we stated above. We went over how buying a call is a bullish strategy and selling a call is a bearish strategy, right? Similar to that, we're going to do the exact same thing with whatever we wrote down, by the way. We're going to see which is a bullish strategy and which is a bearish strategy, and then we'll expand on the same. So write this down. Call credit spreads is a bearish strategy. And put credit spreads is a bullish strategy. Complete opposite. So now call debit spreads is a bullish strategy, whereas put debit spreads, put debit spread is a bearish strategy. All right. So are you guys with me so far? And just write it down in the notes and we'll go over what it means down the road. All right. So credit spreads are separated into two, call and put credit spreads. Same with debit spreads, call debit spreads and put debit spreads. So call credit spreads is a bearish strategy. Put credit spreads is a bullish strategy. Call debit spreads is a bullish strategy, and put debit spreads is a bearish strategy. So first, we're going to start with debit spreads in general, and then we're going to go with credit spreads down the road. But for now, let's focus on debit spreads because that is the closest you can get to when you're morphing from just single-legged options, by the way, single-leg calls and puts. All right. So let's take some stock which we actually trade. Let's take Tesla, which is a pretty famous name. A lot of you have my stuff traded Tesla in the past. A lot of you must have lost money, a lot of you must have made money, but it's a well-known stock which has been traded. So if I open up the option chains on Tesla, open up your brokerage and let's get to work. When you open the option chains on Tesla, especially for the ones which expiring, let's say go for next week. Open the option chains and go for July 5th expirations. What the 200 calls, sorry, the 197.5 calls is zooming. Can you zoom in a bit? Difficult to see. Oh, okay. Let's see. Still trying to figure this one out. Ah, there you go. Can you guys see it now? Better? Is it clear now? Everything is clear. I believe like the Zoom should be doing short favors now. All right. So now, if you're in option chains of Tesla, especially for the ones which expire in the next week, 197.5, July 5, July 5th is the expiration you're looking for, right? So in your notepad, just write down the price for 197.5 call, which is going for 5.28, which is $528. Just write that down. $528 is what it's going for. So let's say you're just trading with a $200 account, right? You're just trading with a, sorry, $2,000 account. This is almost, we're talking about $528. And let's say you set a stop losses at like $20 or something, or sorry, $200 or something. That's a 10% risk, which is quite a lot. Even this overall money which you're spending to open this position is still pretty heavy because it's $528. I mean, initial investment doesn't matter, but Tesla being a volatile stock, if Tesla drops to like $3 from your entry, this position is cooked. So now, just write this down. The price of 197.5 is $530 each. All right. So as someone trading with the smaller accounts, you cannot afford to take this trade. So what do you typically do? You go for, let's say 200 calls. What's the price of 200 calls for the same expiration? 4.15. So just write down $415. 200 strike equals 4.15. 197.5 strike equals 5.28. All right, write this down and we'll get back to what it actually means. So now let's get a bit deeper called debit spreads. Debit spreads are categorized into two. Number one is call debit spreads and number two is put debit spreads, right? Call debit spreads is a bullish strategy. Let's start with call debit spreads first. All right. So, but before we start, did you guys write down the premiums value in your notepad? I'm telling you, write it down because it's going to make things easier for you to understand down the road. Write down the price for 197.5. What's the money you're going to pay for it? And write down the price for 200 calls for the same July 5th expiration. All right. So now the first things to understand, call debit spreads consist of two contracts opened at the same time. If you want to follow along, make sure you're having a margin account and make sure you have level 3 options enabled. Both of them are prerequisites. So before even we begin, so two things, two prerequisites to this, if you want to continue further. So first one, you have to have a margin account. Number two, you need to have level 3 options enabled. All right. So these are the two things which you need to be paying attention to if you want to follow along with the spreads. You can do it right now. It's going to, Robinhood is going to take like 2 minutes to get you approved. Or if you're using Vibo, similar thing. I believe like for newer accounts, they are asking you to take some tests where like you need to contact customer care and they're going to ask you certain questions. And if they are happy with your answer, then and only then they're going to approve the spreads for you. But if you've been using Robinhood for like since 2021 or 2018 or 2019 or whatever it is, you should be like, they're just going to approve it to you just like that. All right. So hope the two prereq was pretty explanatory. The next thing, let's start with called debit spreads. We're going to start here with call debit spreads. And this is as close as you can get when it comes to regular call options, by the way. And if you traded regular call options, this call debit spread strategy is the closest you're going to get to the same concept. So which means, for example, calls are typically a bullish strategy, right? Similar to that, call debit spreads are also a bullish strategy. Puts are technically a bearish strategy, right? Similar to that, put debit spreads is a bearish strategy. So for now, let's start with call debit spreads. So I want you guys to do a small math for me. So we had two strike prices written down, right? So we had 197.5 calls and we have 200 calls. Same for expirations, which is on July the 5th. So now let's let me walk you guys through what you can do right now. So 170.50 is actually going for $528. All right. 200 is actually going for $415. So now when you're planning on opening a call debit spreads, what's going to do, as we mentioned earlier, you're going to be buying one contract and selling one contract at the same time, right? It's like a combination of covered calls and a regular call. That's what you're going to do. So now, for example, you're going to buy 197.50 call option, and then you're going to toggle to the sell above on your brokerage. And once you toggle to the sell, once you press the sell above, go ahead and click on 200 call option right now. So for example, you're going to be buying 197.50, and then you're going to be selling 200. Are you guys with me so far? Let me know if you have any questions until now.
I'm lost.
So let's do a small math. So what happens when you buy a contract? When you buy a call option, what's going to happen? When you buy a call option, they're going to be taking $528 from your buying power, right? That's how it typically goes. But when you're selling a call option, what's going to happen? When you're selling a call options, they're going to credit you with $415 in buying power, right? So now, how much will you pay to open this position? Look up your calculator. Let's do a small math here. So just add 415 and subtract that value with 528, and you will be paying 528 minus 415, $113 to enter this trade. That's it. To enter this trade, all you'll be paying is $113, because when you buy this 197.50, you'll be debited 528. But when you sell this 200, you'll be credited 415. So the difference between both of them is how much you will be paying, which is $113. That's going to be the amount of money which will be taken from your buying power in order to open the trade. So now you can see how less risky it immediately got just from the buying power alone. You're not paying $528 to enter a trade. You're just paying $113 to enter a trade. And even if you're wrong, we'll talk about the maximum money which you'll be losing. The maximum money which you'll be losing is just $113. That is the maximum you'll be losing, even if Tesla just completely collapses from that. Because since it's a bullish strategy, Tesla needs to go higher from your entry price in order to make money. All right. So immediately, as you can see, the amount of money which you need to put forward to open the position went drastically lower when it comes to opening the positions. So let's do another example. Well, let's talk about what's the other, NVIDIA. Let's go over NVIDIA. Open NVIDIA's option chains. NVIDIA is oftentimes pretty expensive, right? Go to NVIDIA's option chains right now. Let's do a similar example for NVIDIA. And go to July 19th expirations. Stay on the call side. Expiration will be July 19th. And check out the price for 123 call options. It's going for $6.03, which is $603. And now check out the price for 125 call options. That is actually going for 5.08, which will be $508. All right? Keep both of these strike prices. So now when you want to open a call debit spreads, you're going to do two things. You're going to look for two things. All right? You're going to be selling in the money strike price and buying in the money strike price and selling out of the money strike price. All right. In this example, 123 is the in the money strike price, right? So you'll be paying 603 in order to buy this. And immediately you'll be selling the out of the money, which will be 125 in this scenario, and you'll be credited 508. And in order to open this trade, it's going to be $603 minus $508, which will be somewhere around the ballpark of, let's do a small math. You'll be paying around $95 and change in order to open this trade. No $600, no $500. All you need to be paying to open this position is $95. We'll talk about how much money you make and how you make money and all that down the road. But so far, are you guys clear with how this actually works when it comes to the pricing? First advantage, by the way. The first advantage is the amount of money which you need to put forth in order to open a position goes down significantly. Whenever people say this is a low risk trade, this is what they mean by the low risk strategy. You don't have to risk a lot of money in order to open a position per contract, by the way. And especially if you're trading with a smaller account, you can clearly see how big of an advantage this already gives it. And you can trade bigger stocks like Nvidia and Tesla by putting in just $95, by putting in just somewhere around like $130, not 500, not 600, not 700. You open doors for trading these names by risking less instead of being scared that it's too volatile for me, I can't trade this anymore. Let me do you guys one better. AVGO is a pretty expensive stock, right? It's like crazy expensive, and the option premiums are ridiculous on that. Pull over AVGO. Go for July 5th expiration. Let me remove this. Let's keep July 5th, just for next week, by the way. July 5th expiration. Look for the price of 1605 calls and look for the price for 1610 calls. All right. If you're trading with a smaller account, if you want to just buy this one call at 1605, you need to be paying $3,130, by the way. If you just want to buy this one call option, or if you want to buy this 1610, you'll still be paying somewhere around 2,950. So call debit spreads is nothing but selling an in the money strike price and selling an out of the money strike price, right? In this scenario, which is the in the money strike price, which strike price you'll be buying. You'll be buying 1605, which is going for 3,130. And you'll be selling an out of the money strike price, which is at 1610, which is 2,950. And what's the amount of money which you'll be paying in order to open this position, by the way? In order to open this position, 3,130 minus 2,950, which will be, drum roll, $1.80. That's the amount of money which you'll be paying in order to open, which will be $180, by the way, when it comes to dollar amount. $180 is what you need in order to open this option position, not $3,130, not $2,950. If you want to convert this into debit spreads, where like you buy 1605 and sell 1610 at the same time, you will be paying somewhere around $180. Let me show you guys the screenshot on how it actually works. Let me just like airdrop it to my Mac. All right, so until now, are you guys clear about the pricing on how this thing works so far? If there is any questions, unmute yourself and ask it right now. Doesn't ask it right away on how things typically goes. Go ahead.
Mario, call debit spreads is when we bullish, when we think is gonna go up, right?
Correct. Yep.
Okay.
Call debit spreads is a bullish strategy, and put debit spreads is a bear strategy, by the way. So we only do call debit spreads if you're bullish on a stock, just like how you treat a call option. That's exactly how we're going to treat the call debit spreads as well. But the only difference here is the amount of money which you're risking when you're taking this trade is going to be far lower compared to the regular calls. And you give yourself a freedom to actually trade names like AVGO instead of taking a step back and saying, it's too expensive, I don't want to trade it, sort of thing. All right, so something to keep in mind on, pay attention to. The amount of money which you pay is, wait, what the fuck, where you go? Wait, where did all the, trying to delete it. What the fuck just happened? Anyway, hope you guys had to record. We had the recording. I don't know what happened, but I believe page 1 is here. My bad. It's still there.
Mario, I had a question for you.
Go ahead.
The credit spreads, right?
Correct. No, debit spreads.
Is that the same thing as the vertical spread?
Debit spread
when I look
is
at
a subcategory of vertical spreads.
Okay. Because when I look at my Fidelity options change, I didn't really see the vertical spread, the ratio spread, and the diagonal spread and calendar spread.
Yep. Don't worry about calendars. Yeah, don't worry about calendars yet. Only for vertical spreads, whatever we discussed right now.
So it'd be the vertical spread.
Yep, debit and credit spreads or vertical spreads.
Okay, cool. Just wanted to know that. Thanks.
Yep. So now let me just show you guys how to do this in Robinhood. I will just like send you a screenshot right now in the Zoom chat. Check that out. The AVGO example, by the way. Did you guys see it in the Zoom, which was just uploaded? Where we buy, you see buy to open, which means you're buying that 1605 call. And you see sell to open. And what we're doing there is selling that 1610 call, one in the money and one out of the money at the same time, at the same exact time, by the way. You buy 1605 and then you toggle to sell. You can see it in the background where you see buy, sell, call, and put. Stay in the call, just toggle to sell and then select 1610. And when you scroll it up, you'll see it marked as call debit spreads. So in here, you can see something called as max loss sitting at $180, which is the premium which you paid. And max profit is sitting at $320. How do you think that is calculated? Let's talk about it. So before we move on to that, are we clear until now? We're good, we're good. Press 1 if you're good, and we can just like go ahead with the next maximum profit thing and how it's calculated. All right, beautiful. Now let's go ahead and talk about the maximum profits. What the hell is this? Someone messed with this thing. I don't know what's going on in here. There we go. All right, so now 1,610 is what we sold, right? And then we purchased 1,605. What's the difference between these two strike prices? It's a $5 difference. That's what I meant. So for example, initially we purchased 1,605 and 1,610. The difference between both of them is $5. This is what we call as width of the spread, by the way, technical terms. Width of the spreads is $5, which means the difference between the buy and the sell strike price is $5. 1610 minus 1605 equals 5. So now the maximum profits which you can make from a spread, from a call debit spreads or put debit spreads, is the width multiplied by 100, which is equals 500. All right, that is the maximum money which you'll
Can't
be
see
making.
nothing.
Go ahead, Franklin.
Can't see nothing.
What is that?
The screen is blank.
Screen is black. Just can't see it. Hold on. Can you guys see it now? You clear? Let me know if you guys can see the screens.
I can't see it. I still can't see nothing.
All right, hold on.
The rest of the students see?
How about now?
Oh, it went. It was there for a second and it went away.
Cursors are hidden because there are far more users on the board. Enable cursor. Yeah, we clear? Should be working good now. Let me know if you still have problems and we can figure something out. We'll just share it through TradingView and we'll work on it. You can see? All right, better, perfect. All right, so let's get it started. And now, as mentioned before, the width of the strike price is, let's say, for example, in this scenario, you have, let me write it down, 1605 and 1610, and the width is 5, and the maximum money which you will be making will be width into 100, which will be $500 in profits. With debit spreads, your maximum profits are capped, by the way, unlike calls. You know, you saw the advantages, right? The amount of money which you're putting in up front is less. The disadvantage is the maximum amount of money which you'll be making to the upside is capped as well. So now, how much is the maximum amount of money? This is how you calculate. In this scenario, if you go back to the screenshots where you see the maximum profit is 320, I'll tell you how it's calculated. Now the width is 500, right? So 5 into 100, so which is 500 minus the premium you pay.
Hey, Coach, I'm sorry to interrupt you, but I can't see anything.
Can you guys see this? Like, what's going on? Zoom in. Oh yeah, Larry, looks like you have to zoom it in order to see the same.
Zoom in. Say zoom in.
There should be something called as whiteboard. As soon as you see it, you should. You know what? You know what will make things easier?
Oh, hold on. It says view only. No, I can't see that. No.
Hold on. This is the first time I was using whiteboard, so we'll just do the typical things,
Open in split screen. Open in proper look like after.
Don't worry about it. Don't worry about it. I got you guys. Hold on. I'm just going to share this TradingView screen. These whiteboards are new to us, so we'll just share the TradingView and we're just going to use the notes on TradingView to trade right over there. All right, so hope you guys can see this screen right now. The screen would be.
Okay, great. We good.
All right.
Yeah, we can see that.
Perfect. All right, so now, in order to calculate the maximum profit, it's a pretty simple thing. So calculate the width of the spreads, subtract that by the premiums you pay. So if you go back to the screenshots of the AV Go, so the amount of money which you need to open the contract is $180, right? $180 is the amount of money which you need to open that contract. But the width of the strike prices is $500. So the maximum profit will be 500 minus 180, which will be $320. That is how you got the 320 right over there, by the way. Are we clear on this one? So let me send you guys another example. So tell me another stock which you guys trade. I'm pretty sure most of you trade AMD, right? Let's do the same on AMD. Let's do a debit spread example for AMD to see if something good shows up in there. All right.
Hey, Coach, I'm sorry. I know I'm just getting in. I'm late, but I got a question. We're doing credit. So if you're selling a call, do you have to have 100 shares in order to sell
No,
the
no, no,
call?
no, no. You don't on this scenario because if you're selling covered calls, you need to have 100 shares in collateral. 100 shares as collateral. But since you're buying an option and selling an option, that option which you buy is going to act as 100 shares, by the way. So you don't need any collateral to open this
Right.
position.
Right. Gotcha. I understand. Okay.
All right. Yeah.
I'm good. Yep. Got it.
So now go to AMD and open AMD option chains and go to July 5th expiration. Select 160 call. Write down the price for 160 calls, by the way, for AMD. So AMD 160 calls and 162.50 call. Those are the two which we are going to go for. Which one is in the money here? 160 is in the money compared to the price. Current price is 162.22. 160 is in the money, which will be, you will be buying 160 strike price and you'll be selling 152.20 strike price at the same time. And now when you do that, what's the width of the spread before even I send the screenshot? What's the width here? 162.50. No, this is a debit spreads. Whatever we are doing is debit spreads, by the way, not credit. We're first going to talk about debits and then we'll go over to credits. So what the width here, by the way? So it's 162.50 minus 160, which will be 2.50. So what's the maximum profit that you can make? $250 will be the maximum profits. Not maximum profits, like the overall. That's the maximum you can make. So now, let me send you a screenshot of the same and tell me if you understand whatever you see on the screen right now. Sharing it right now. Got it. Check out the Zoom chat. You guys should be getting screenshots in there. So now, when you buy 160 call option, you'll be paying $425. When you sell 162.50 call option, you'll be getting a credit of $289. So how much you'll be paying in this scenario will be $137, by the way, in order to open this trade, which will be 250 minus 137, which will give you 113, which is the maximum profits which you can make on this trade. Are we clear with the math on how this maximum profit is calculated? We first calculate the width of the spread. Number one, here the width of the spread is 252.50, which is $250. Multiply that with 100. So it's a step-by-step process. And first things first, calculate the width. Nothing but difference between the strike price.
Mario, the width, why you went with 2.5 and not
Second
5?
step, multiply the width with 100. Third one, subtract the value with the premium paid. And you get the maximum profits. That's it. So pretty simple. In this scenario, 250 minus 137, which will give you $113, which will be the maximum amount of money which you'll be making if you're right. So if I went and buy a normal call, I'd see that to buy one, it'll be 425 because we're buying and selling. Yes, this is the main advantage, by the way. If you want to go ahead and buy a 160 call, you'll be putting in $425 in order to just buy this option, by the way. But since you're doing debit spreads, you still get to stay on a bullish side of the trade, but by risking less. Since you're risking less, you're also making considerably less here. But with the risk which you're taking, the amount of money which you'll be making on a percentage basis, it's still crazy high, by the way, especially if you're trading with a $2,000 account. We're talking about somewhere around 5.5% in profits, if you're right. And by risking somewhere around, like, you're not going to hold on to it until it completely falls apart. And let's say even if it completely falls apart, you're going to be losing somewhere around like $30 to $40 maximum if it completely falls apart. And you're going to get stopped out with a smaller loss, because this spreads is not going to be as volatile as these options, by the way. They're not going to move as volatile as whatever it is, because every time it goes down, the options that you sold is going to be making you money, but the options that you bought is going to be losing you money. So thereby keeping your losses, even though if it goes down, even if you lose money, the losses will stay consistent. It's not going to be hefty or heavy and not as volatile. Something to keep in mind. So max risk is the total cost. Max risk is the amount of money which you pay to put forward. That is like if everything goes against you, that's the amount of money which you will lose. So now, what needs to happen in order for you to make that $113? That's the next question we need to ask ourselves, right? I mean, with call options, we know if the stock price goes up, you're going to be making money. Similar to that, in debit spreads, if the stock price goes up, you're going to be making money. But what's the advantage, right? What's the advantage of debit spreads over calls? You can might as well just buy a call option on a cheaper stock, and you won't even be paying $130. You'll be paying like $60 per strike price. Why do we have to do debit spreads instead? Why can't just do call options instead of this? Before we get to that, any questions so far about calculating the maximum profits? Let me know. You can unmute yourself. Let me know right now. We're good. Alex is good.
Mario, the
Everyone
width.
else is all right.
Mario.
All right. Looks like it. Okay. So now we're going to stick to this AMD example. All right. Two strike prices which we have, right? 160 and 162.50. Those are the two strike prices which you have on the screen right now. If you, let's say you buy a 160 call by spending $425, next week is a short week. Wednesday is half day, I believe. Thursday is half day. One of the days half days, and one day the markets are closed completely. So technically it's 3.5 trading days instead of 5 trading days. And let's say Monday, AMD just trades flat for the entirety of the day. What's going to happen to this 160 call option? If the stock is just trading flat on a 3.5 days, yep, it'll go down. Even if the stock price isn't going down, let's say AMD was just consolidating between 160 to 162.50 throughout the entirety of the day, your options are still going to get absolutely screwed, by the way, even if it didn't go higher or even if it didn't go lower. So let's say Tuesday happens, same exact scenario. AMD is just consolidating, nothing is happening. You're still going to be losing money. And regardless of what it does, if it's trading flat, it's done for. It's a disadvantage, right? Because data is working against you in your favor. But in here, when it comes to debit spreads, you see how you structured, you got 160 to the bottom and 162.50 on the top. All it needs to happen from the price is by your expiration, AMD needs to close above, even a single cent above 162.50. If it does, you get to keep your maximum profits. That's it. It doesn't matter if it goes down. It doesn't matter if it goes up. If it's just consolidating, you're going to be making money. Data decay is going to work in your favor. If it consolidates, you're going to make money. And if it closes above that 162.50 call, the higher end of the call, even a single cent above it, you're going to keep that maximum profits, 100% of the maximum profits, by the way. You don't have to worry about data decay. You don't have to worry about IV crush. You don't have to worry about any of that. All you need to care about is if the AMD is going to close above my sell side strike price, which is 162.50. If it happens, you get to keep 100%. If it doesn't happen, you're still going to lose, but you're going to not lose like the entire 137. Let's say AMD closes at 161. You're just going to lose somewhere around $40 on this. You could still get to keep somewhere around like 97 of your initial investment. The only risk here is if AMD closes under 160, you're going to lose $137 on the trade. It needs to close, max loss is 137, exactly. If AMD closes under 160, you're going to lose 137. But by expiration, if AMD closes above 162.50, you get to keep the maximum profits. But let's say the same scenario, AMD is just consolidating, not doing much, not going above 160, not like just 163 to 160 is where it's consolidating from back and forth, back and forth. And on day one, you make like $10. Day two, you're flat. And on the final day of expiration, it just goes all the way to 163. And all of a sudden, boom, you're just up like 80% on this position. You just made $90 all of a sudden. Because at the end of the day, the more the theta decays, especially on zero DTs, most of the people tell you to avoid zero DTs for the same reasons, right? Because the theta decay in higher extents. So, but in this case, theta decay is healthy. The more the theta decays, the more money you're going to make. So all it needs to do for AMD is to close even like 5 cents or even 1 cent above this 162.50. You get to keep that $113 in profits to the upside. Now go back to the AV Go screenshot, by the way. Similar, exactly similar scenario. If you go back to the, what other we got? We got, yeah, AV Go. We got two calls in there, right? So one is 1610 and the other is 1605. All AV Go needs to do is close next week above 1610. If it does that, you get to keep $320 in profits. If it closes under 1605, the maximum you will be losing is $180, not $3,130, not $2,950. All it does, if it continues to keep pushing up, you're still going to be making money just like how you do with call options. You don't have to wait till expirations to sell this, by the way. You can close it anytime you want. Typically what people do is they're going to close it once they hit 50% of the profit. Let's say for the AV Go to trade right here, if I just show the screenshot, hold on. Yep, hope you guys can see the screenshot on AV Go, by the way. Let's see. It's too slow today, I don't know what's going on. Can you guys see the screenshot right now on the AV Go on the screen? No, I don't think so. I don't think so. Oh, that's all right. It doesn't matter. It's posted in the. It's posted beyond. Let me see. Should be working fine now. The new update on Zoom is just really annoying. It's just completely changed the UI for me from my end. This is Apple. This is not what we're talking about. Yeah, this is not the screenshot I wanted to share. This is for Apple, by the way, and I wanted to share. You know what? Let me just share the entire screen. There you go. Found it. There it is. Right. So now in this screenshot right here, you see how 1605, you don't have to pay like 3130 to open the trade. You don't have to pay 2,950 to open the trade. The maximum risk here is $180 if you're wrong, which means you will be wrong if AVGO closes under 1605 by your expiration date, by the way. But if it closes as even a single cent above 1610, it doesn't matter how it gets there. As long as it gets there and closes above 1610, you get to keep a maximum profit of $320. So you're risking 180 to make 320, just like how we trade futures, by the way. As long as it goes in your direction and closes above the entry price of your longs, you're still going to be making money, right? If you're long the futures, as long as it stays above your entry price, you're going to be making money. All it needs to be doing is like stay above your entry price. Similar to that, all it needs to do is stay above this 1610 by expiration. You get to keep this maximum profit of $320. So this is for call debit spreads, by the way. Always remember a pattern. We always buy the lower strike price and sell the higher strike price. Here, it's 1605, and then we sold 1610. If you go to the AMD's example, we did the exact same thing. We sold the 160. Sorry, we bought the 160, and then we sold the higher strike price, which is 162.50, by the way. All right. So call debit spreads are a bullish strategy. Now, hope you're clear on how call debit spreads work, by the way. Two advantages here. You don't have to worry about all these theta decays and all these other IV crush and all that. As long as the price stays above the range of the strike prices which you open, in this scenario, 1605 to 1610, right? As long as it stays above 1610, and the longer it stays above 1610, you're still gonna be making money over and over and over. Let's say AV go just like rallies on Monday and goes all the way to 1630, and then throughout the entirety of the week just consolidates at 1630 over and over and not making anything, and then by expiration it just closes at 1628 or something. You still get to keep $320 in profits because it closed above 1610. It doesn't matter what it does after it crosses, as long as it doesn't come back down, crashing down and close under 1605, so you should be good to go. And call debit spreads or bullish strategy. And now let's discuss put debit spreads. All right, what is the question? I'll have a question. So if AMD closes in between 160 and 162, we would lose anywhere between 0 and 1% closes. And yes, correct. So if AMD closes anywhere in between 160 to 162, there's something called as break-even price, by the way. Here, the break-even price will be around 160 plus 1.37, which will be 161.37. If it closes at 161.37 by expiration, you make $0 or you lose $0 because it's at your break-even price. Anything under it, you're going to be losing money, but anything under 160, the entire position is a done. If it closes at 161.37, just add the premiums which you paid to the lower end of the strike, you'll get the break-even price, by the way. You see that 161.37 in the screenshots. If it closes at 161.37, you won't be making any money or you won't be losing any money. Go ahead, what's the next question? Always 21 days out. 21 days out to expiration all the time. Don't do the weekly spreads. 21 days out to expiration. And please give yourself 1 month out. Go to the spreads chain and then look at what we did with Ryan, by the way. That's exactly what we did. 21 days out, so that even if it continues to go against you, you get the opportunity to roll that further to extend your expiration, by the way. So you have to put yourself in a position where like you can manage it instead of like 1 day of wrong moves just gonna wipe out like the entire thing, whatever you made sort of scenario. Wait, I can't hear you. 1 minute. Just a minute, Franklin. I don't know what's going on. Go ahead. Why can't Can you guys hear him? It's just on my end. I don't know what's going on. Franklin, I'm so sorry. Just a minute. It's just a speaker thing. What's going on? I'm not sure. It's just a speaker thing. What's going on? I'm not sure.
Let me know. I don't know if it's my end.
Headphone. Should be good to go. All right, Franklin, go ahead.
Yeah, you can hear me now?
Yep, perfect. Go ahead.
Okay, on the width, right? When we go into the option, is the first price in the money and out of the money?
Mm-hmm.
And that's it. We don't go no further than that.
Yes, so you can go as further as you want, but for now, just stick to 1 in the money and 1 out of the money from where the price is trading. All right, so you don't have to do something like if AV goes trading at 1600, you don't have to do like 1710 and 1720. That is like too far away. But you're gonna buy the strike price of a lower number and then sell the strike price of the higher number. In the AMD example, 160, we bought it, 162.50, we sold it, which is like $2.50 higher than the call options which you bought. If you go to the AV Go screenshots, we bought the 1605 and then we sold something which is higher than 1605. So you got to buy the lower strike price and sell the higher strike price if you want to open a call debit spread, by the way.
Yeah, no, that's what I was looking at because the AMD was the width was only 2.5 and the AV Go was 5. And I was like, wait a minute. And then now I got it. The first in the money and the first out of the money.
Yeah.
First strike. Got it.
There you go. Talking about managing how we manage the risk on this, or we don't need to go to max risk or something. All right, there are 3 different ways you can manage the call debit spreads. Let's say like overall trend is still positive. Just like what do we do in shares if the overall trend is still positive? We don't make any changes to our positions, right? Similar to that, as long as the overall trend is still positive, As long as the stock price is trading above our both of the width or both of the strike price, there's no need to be managing it in any way, shape, or form. Since we have 21 days to expiration, as long as it's in an uptrend, we don't need to do anything to manage the same. But let's say down the road, it starts rolling over. When it starts rolling over and it breaches the 160 leg, which we have on AMD, and it starts to go down. If that happens, and if you see the trend starts rolling over, you can either completely just close it. And even if you close it, you wouldn't be losing more depending on when the rollover starts, because once we hit 50% in profits, we're going to close that position anyway. But let's say like it went down like 10% from your entry or 20% from your entry to the downside, which is 20% of 137 will be somewhere around the ballpark of $26, which is no more than like 0.2% of your account. If it goes down like $26 or something, and if the trend starts really showing weakness, you can just close the entire position. Or what people typically do is they just extend their expiration, they roll it further into next month. And when they roll it further into next month, the sooner they do it, the more credits they're going to get, which means you're going to get paid to roll it up. All right. So something to pay attention to. So there are scenarios where you roll it further to extend your expirations. There are scenarios where you just completely just close your positions. So depending on the setup, the management varies. But for now, one thing which is set in stone is once you hit 50% in profit, you're going to close the position. That is set in stone. But when it comes to managing, when it comes to cutting the losses, dominant trend plays a major role. If it's still in an uptrend, no need to make any changes, no need to manage the same in anything, any way, shape, or form. If the trend starts rolling over, we'll make the changes accordingly down the road, sort of thing. Yes, it'll be available, Larry. You should be good to go. All right. So call debit spreads. Hope we are clear on that one so far. We good? So now put debit spreads is similar. Now follow me along on this one. All right. And stay on the AMD's option chains. But now go to the put side. Instead of the call side, go to the put side of the section. So let's say you're bearish on AMD right now. All right, so you're expecting AMD to go lower. Make a note of what the price of 160 put is. Same July 5th expiration. And make a note of what the price of 162.50 puts are. The price of 160 put is $1.88, which is $188. And the price of 162.50 puts is $305. All right, so now let's do it. What's the width of this? What's the width of the spread? Same, $250, right? $250 is the width of the spread. So now, how would you calculate the amount of money which you pay to enter this trade? 305 minus 188, which is how much? $117. 117. So 250 minus 117, which will be $133, which will be your maximum profits. So now, in order to open a put debit spreads, what are you going to do is you're going to do the exact opposite of what we did in the calls, by the way. In call debit spreads, what we did, we sell, let me just write it down. Call debit spreads, you sell the lower strike, buy higher strike. Sorry, complete opposite. Buy the lowest strike, and then you sell the highest strike for call debit spreads. Where do you get the 250? Pretty simple. Just it's 162.50 minus 160. That's the width, the difference between the two strike prices. Right? Yeah, that's what we call as a width of the spread, by the way. That is used to calculate the maximum profits, which you saw. 2.50 equals 250. Exactly. Yep. Multiply that by 100. So now, with call debit spreads, you buy the lowest strike and you sell the highest strike. But with put debit spreads, it's complete opposite. You sell the lower strike on the puts and you buy the higher strike, by the way. All right. So you're selling something out of the money and you're buying something in the money. And as it goes lower, you're going to be making more money in your favor. I have to listen to the recording tomorrow. No worries, man. Take your time. All right, so now let me send a screenshot for put debit spreads again. And once you see the difference, it's gonna make more sense. Let me just transfer this to the computer. And this is what we call as put debit spreads, by the way. Go to the put section and try this one out. Look at what we did. We purchased, let me just share the entire screen so that the recording goes in there as well. Right. So you can see the Zoom chat here as well, right? Should be clear. Right. So now you can clearly see. Yeah, you should be able to see this one, right? All right. So we sold the lower strike price, which is 160 sell to open, and we purchased the in the money, which is higher, which is 162.50. So now you're paying $3.05, but you're receiving credit for $1.88, which means the overall total cost will be $1.17 to open the trade. So watch the bet. 250 minus 117 gives you $113 in profit. Right now, how this one works is as long as AMD closes even 1 cent under $160, you get to keep the maximum profits. So now if you go to this one on contrast with AVGO, it's completely opposite, right? As long as the AVGO closes above 1610, you get to keep the maximum profits. In here, as long as it closes under 160, you get to keep the maximum profits. As I mentioned earlier, put debit spreads is a bearish strategy. Call debit spreads is a bullish strategy. So when it comes to call debit spreads, you're going to buy an in the money option and sell an out of the money option. When it comes to put debit spreads, it's exactly the same. You're going to buy an in the money put option and then sell an out of the money put option. But in here, in the money in the calls is always under the stock price, but in the money on the puts is always above the stock price. But for now, just remember this. You buy an in the money options and then sell the options which are out of the money if it's for call debit spreads. Similar to that, you buy an in the money option, which in case 162.50 is in the money, and you sell the out of the money options, which is 160 to the downside on the puts. Right? So how many of you are in here or having level 3 for options, by the way? I have level 3. All right, good. Go ahead and test this out, Brian. Open your Robinhood account or open your options. And let's give it a try on Apple, all right? So let me give you guys a small exercise to work on. Go to Apple's chart, AAPL. And I want you guys to open call debit spreads for July 19th for 210 and 212.50, by the way. So call debit spreads, not put debit spreads, call debit spreads. 210 and 212.50. That is for call debit spreads. And for the same to the downside, for anyone who's bearish on Apple, open a put debit spreads for 215 and 210. July 19th, July 19. All right, so let me have a question. So Ryan is like this. Now it says you got 155 and then 60 to keep. So the max loss, which it seems to be 370 minus 135. All right, so what's the width of this, by the way, Alex? The width of this is 500, right? So the amount of money which was paid to enter this one is $250. The amount of money which was paid is 250, 2.50. So now width minus the money which paid to enter the trade will give you the maximum profit. If you go to the screenshots in the Discord, which you can see right now, let's see. You go right here. Yeah, so it's pretty simple, right? So the amount of money right here, you can see. Buy 55 puts and sell 60 puts. This is credit spreads, by the way. This is not debit spreads. It's completely different. So now total credits received to open this trade is somewhere around 250. We get credits to do the same. We didn't cover credit spreads yet, but it's credit spreads equivalent. All right, so this, what we did right here, put credit spreads, which is a bullish strategy. What we're discussing right now, it's just debit spreads so far. So are we clear with the exercises yet? So Apple for call and put debit spreads, give it a try. Let me know how you do it. For Apple, go to July 19th expiration. And I want you guys to open a call debit spreads for 210 and 212.50. And anyone in here can participate, by the way. Which one will you sell and which one will you buy if you want to open a call debit spreads for 210 and 212.50? Which strike price you need to buy, which strike price you need to sell if you want to open a call debit spreads. Sell 212.50, correct. Which one will you buy? You'll be buying 210. All right, so that is perfect. So what is the total risk and what is the total amount of money, maximum amount of money which you'll be making? Yes, we are in Apple, Alex. You're good. You're right. We are in Apple, and the total, what we are doing right now is trying to open a call debit spreads on Apple, 210 and 212.50. July 19th expiration. And we're also planning on opening a put debit spreads on Apple for the same expiration, 215 and 210. If you're opening a put debit spreads, which one will you sell? Which one will you buy? 215, 210 for July 19th. Okay, hold on, let me try the math. Go ahead and try it out in your brokerage. Experiment in there. Let me know if you guys have any confusions with call and put debit spreads when you try it out in your brokerage, by the way. Go to the Robinhood and enable level 3 from, if you go to your account settings, you can enable level 3 from there under the investment tab on options level 3. You should be able to go do it over there. Give it a try, let me know. I'll give you guys a couple more minutes. Alrighty, so Brian, you're right there with the put debit spreads. Alex, how are you doing? No. Just open your Robinhood, Alex, and open your Robinhood. And I just logged off my phone, so to get on the laptop. Yep, go ahead, take your time. Go to the Robinhood and give it a try in there. Just apply it, learn it through application. Maximum profits is 85, perfect. And what's the max loss? Now reverse engineer it. How did you get this 165? How did you get this 165 and how did you get this 85? Now do the math here. So the max loss is 165, and that is calculated based off of how much money you'll be paying, right? The premium paid for the calls, subtracted, correct. That is the max loss, which will be 165. The maximum profits, how is that calculated? Calculate the width first. Width is 250, right? 250 subtracted by the max loss, which will give you your maximum profit. 250, exactly. There you go. Yep. So now open a put debit spreads for me. That is the max loss. That's how we calculate it. Hope that makes sense now. So now go to the put side and open a put debit spreads. You got to buy an in the money put and then sell the out of the money put, by the way. It's called so-called put debit spreads, correct. So now you're going to go for put debit spreads, put side, open a put debit spreads for 215 put and 210 put, July 19th, same expiration. 215 and 210. Buy an in the money put option and then sell an out of the money put option. And tell me what's the maximum losses and what's the maximum profit is. You did it wrong. 215 and 210, by the way, not 212.50 and 210.
Mario.
Go ahead, Franklin.
And Webull, it only gives me the option of 212 for the put, 212.5 and 215. It'll give me 215 and 210.
You can change the width on Webull, Franklin. Currently, your width is stating at 2.5, right? You in the settings, you should be having an options to change the width to 5. And when you change it to 5, it'll automatically give you the put debit spreads for 215, 210. Right now, you see 212.50 and 210, right? Like, which is 2.5 width is what you're having right now on the settings.
Yeah, but then that'll be out of the money for the puts. No, I'm sorry. I don't have the 215 and 210.
What do you have?
I have 212, that's in the money. I have 212.5 and 215.
Both are in the money, but it's still a put debit spreads, by the way. Still a put debit spreads. So as long as it stays under 212.50 by your expiration, you're still going to be making money. What I'm trying to tell you is if you want to increase the width, you can do that through the settings on Webull, by the way. On Webull, you should have a specific settings for changing the width. And once you change the width, it'll automatically change every single options that you see to accommodate your width, whatever you have. Right now, your width is like 2.50. Just change it to 5 from the settings. You should be good to go.
Okay.
So no, we are looking for 215 and buy 215 and sell 210. Exactly. Yep, there we go. For Robinhood, you don't have to worry about that. This is only for Webull, by the way. This is only for Webull. For if you're using Robinhood, it's easier. You just go to the, just make sure you have level 3. If you don't have level 3, you can't do any of this. So if you have level 3, go ahead and buy the 215 put, click on the plus icon right next to the 215 put, and then go to the sell and click on the plus icon at the 210 put, and you're going to be getting something called as put debit spreads. Max loss is 293 and max profit is 207. Exactly. There you go. You got it. So this is how you open put debit spreads, by the way. Let me give you guys another small exercise. So let's start with, let's go for Google, which is in an uptrend, right? Google is in an uptrend. Let's start with Google. Go for the same July 19th expiration. Open a put debit spreads on Google for 185 and 180. Put debit spreads for 185 and 180 for Google. And anyone who's following along with Webull can go ahead and do so as well. Max loss is 258. 185 and 180, Brian. 180. So now, why don't you explain what it does, by the way? Now you know how to open. So why don't you explain what it does? If you open this put credit spreads on Monday, what needs to happen from the price for you to make this maximum profit? By expiration, Google needs to be, is it a bearish or bullish strategy? It needs to go under 180. Beautiful. There you go. Buy 185 and sell 180. Perfect. Bingo. Now let's do the call debit spreads. Do a call debit spreads on Google for 180 and 190. The next exercise is same expiration, call debit spreads for 180 and 190, by the way. Max losses 419. Beautiful. Max profits. Sell 190 and buy 180. There you go. Hope you guys are getting a hang of this right now. This is how you open call debit spreads, and this is how you open call put debit spreads, by the way. So call debit spreads is a bullish strategy. whereas the put debit spreads is a bearish strategy. So you'll be making money if the stock price goes up, and you'll be realizing maximum profits if the stock price closes above the sell side price for call debit spreads, and you'll be realizing the maximum profits if the stock price closes under the sell side price for put debit spreads. Are we clear on both? For what call debit spreads means and put debit spreads means? And look at the amount of money which you're spending to open these trades, by the way. Look at the risk which you're taking, which is very less. This is why spreads are really good when you're trading with smaller accounts, by the way. For the next week, what we're going to do is we're going to focus on call debit spreads alone. We're going to leave credit spreads alone for now. I'll teach you guys what credit spreads means once you got used to debit spreads in general. All right. So I will see if we can open any positions on the same, a small position, testing the water sort of positions. All right. No, we open put credit spreads on Ryan. Put credit spreads is a bullish strategy. It's the same. It's similar to call debit spreads, but let's do the exercise. Let's say like you want to open a call debit spreads on Ryan. What will you do? Change that put credit spreads into call debit spreads. Go ahead. Go to Ryan and do the exact same thing what I posted in here. Right here, what you see on Ryan is something called as put credit spreads, by the way. So now convert this into call debit spreads. How will you do it? Same expiration, which is August 16th. Do the exact same thing and tell me what you see. With this $5, correct? Give it a go. Max loss 0.08. There you go. Hope it makes sense. Max profit 192. Beautiful. So what you did right now, you just converted a put credit spreads into a call debit spreads, by the way. So in the call one, it needs to go above and it needs to close above $60 by August 16th. That is what we're expecting. Or it needs to stay above $55. We went for August 16th, not July 19th, because we need to give it some time, because it's a risk-defined trade. And we will know that we're wrong if they lose that breakout area. And they're both bullish strategies. Right. For credit spreads, it's completely opposite. Call credit spreads is a bearish strategy. Put credit spreads is a bullish strategy. Let me just write this down in here so that like it will be easier. You can just take a screenshot of it. All right. So let's put it this way. Call debit spreads. Put debit spreads. Call credit spreads. Put credit spreads. All right. So I'm going to let you guys answer this for me. Call debit spreads, bullish or bearish? We're talking about debit spreads, by the way. You guys just did it right now. Bullish, beautiful. And what about put debit spreads? Put debit spreads is bearish. All right. So now when you go to the call credit spreads, it's just complete opposite, by the way. Call credit spreads is bearish and put credit spreads is bullish. There we go. So this is what it means. So don't worry about credit spreads for now. For credit spreads, you need collaterals. For debit spreads, you don't need collaterals. We'll discuss about what collateral means and all that other stuff down the line. But now I hope the basics of debit spreads make sense, by the way. So for example, like next week, we will look for some smaller setups like Palantir. We'll open some debit spreads on Palantir to test the waters, to see how it works. When you actually see it working in your favor or working in real time, whatever we discuss right now, it's gonna make more sense. We'll open something on Palantir to see how it works. Just keep it watching. The point of that spread is not to make money, but for you guys to get familiar with it, right? The Palantir is in an uptrend. So go to the Palantir July 19th expiration right now and just look for 25. Buy like open a call debit spreads on Palantir for 25 and 25.50. 25 and 25.50, just one contract. So the total risk will be $25. Maximum profits will be $25 as well. So if you're dealing with a $2,000 account, it's just 1% risk. So it's 1%, which is, okay, Palantir, 25 call debit spreads, 25, 25.50. For expiration, July 19th. 25, 25.50, which means you'll be buying 25 calls and you'll be selling 25.50 calls. Max loss is 25, max profit is 25 as well. So 25, if you're dealing with like a $5,000 account, which is like no more than less than 1%, less than 0.5%. So you can go ahead and take this risk. Yep, exactly. I see the same. Yep. So go ahead and we'll give it a try. Give it a try next week. Because if you're going to take this small account to the next level, as promised, we said like we're going to wait until July before we do any of these things. So July is about to get started. So pretty sure if you're following, if you're with me, most of you guys in here have been with me since November. So we've been trading these small accounts since November to right now, and we've been doing pretty good. So now let's take it to the next level instead of being stagnant, right? The last thing you want to do is staying stagnated in doing the exact same thing over and over. Learn something new along the way. So this is something new which we're going to do. We're going to start with debit spreads for next week, and then we're going to build off on top of it. And then we're going to do credit spreads down the road. For now, stick to debit spreads. And if you understand the concepts of debit spreads, credit spreads is going to be like easier down the road as well. So it's not that different from the debit spreads after all. So if you're dealing with the smaller accounts, start with debit spreads. And I made it as simple as possible. And I would highly recommend you guys to go to the Tasty Trades YouTube channel. Let me show you guys which one is it. There we go. If you go to the Tasty Trades YouTube channel, you should see something called as long vertical spreads. Look at all these videos. Now you understand the basics of the same. Go to this channel and check out every single video which they have on vertical spreads. Now you know the basics. Now you understand what it means. Now, whatever they say, it's going to make more sense to you. So use this weekend to learn all these. And if I come across some great tutorials for debit spreads, I'll send it your way as well. Now that you understand the basics, whatever you watch is going to click right then and there immediately. So if you want to manage the debit spreads, go ahead and check this one out. I will just share it in the Zoom chat right now. Alex, you asked how to manage the risk on the same, right? Go ahead and check this video out. This video talks about the exact same thing. How do you defend the debit spreads to the downside or credit spreads to the downside or upside if it starts going against it? Go ahead and check these videos out and get back to me if you have any questions. Do some research on debit spreads alone. Don't worry about credit spreads yet. We'll do credit spreads down the road after next week. Once the next week is done, we'll talk about credit spreads in the same time. We'll talk about it, we'll discuss in detail. And for anyone who's using Webull, just go to YouTube and type Webull. Just type debit spreads Webull, and it'll immediately tell you how to open one from the Webull directly. So I'm just going to share this link as well. And this guy is pretty good, tech conversations. He has a lot of good videos. So I believe I can trust him to share it with you guys, but give it a try. I didn't watch this video, so check it out. So theoretically, if I could open Palantir call debit spreads, the cost is $25 on Monday and have it to July 19th. Leave it alone until it's what happens between now and July 19th and September 25. Yes, correct. But we are not going to be holding this until July 19th. Let's say like on Monday, Palantir rallies all the way towards $26 or $26.50 or something. These spreads are already going to be up like 50% immediately. Once you're up 50%, you're gone, you're out. No point in holding on to it. 50% is the maximum. Once you make the 50, you're out. So don't get greedy for the other 50% and then lose the 50% which you already made. So we're only going to start with one contract, by the way. No multiple contracts at the same time, not yet at least. For now, start small. One will be $25 risk, stick with one. Yep, exactly. 50% will be $12.50. Yep, there you go. This is for learning purposes only, to get familiar, to get your feet wet. Start here, and then we can eventually go to like opening a spread position on AVGO or opening a spread position on NVIDIA, Apple, Tesla. Now we can trade all these big names, by the way. You guys want options? This is how you do it in your small accounts. Low risk, better control over how much you will lose even before entering the trade. Easier to manage. You don't have to keep staring at your screen every single time. All you need to look for is where the price is. If the price is above your strike price, that's it, good. You can just close your brokerage and walk away. If the price is under, are we still in an uptrend? If it's still in an uptrend, walk away. If the trend starts rolling over, then we can come back and manage the same accordingly. So we'll go over the management when certain situations show up. And I really hope Palantir, once you open, it goes against us so that like it'll serve as an opportunity to like show you guys how to manage the same down the road. So we'll take care of it down the road. All right. So this session is recorded anyway, so I will post the recordings down the road. And we will take the credit spreads from next week. For next week, we're just going to focus on debit spreads only. All right. So buying a call and selling a call, or buying a put and selling a put. We'll stick to this. And if something great shows up, we'll take it. And hope you guys have a wonderful weekend. And I'll share this recordings once it's done. And I have like 2 more recordings which needed to be shared. I'll share all of it by this weekend, and I'll let you guys know down the road. Take care, everyone. And if you have any questions based off whatever we talked about, feel free to reach out to me. I would answer in depth for whatever questions you guys have. Take care. Have a great weekend. I will see you guys Saturday or Sunday. We'll see. Bye-bye.